Hello and welcome to this webinar. My name is Stanislav Bernikov and I'm a full-time professional trader with more than 10 years of experience. I will be a host in this webinar where I'm going to share with you some interesting information concerning trading. If you have any questions, feel free to leave them below this video. Enjoy! Let's get started. This webinar is the second in a series of two webinars titled Price Action and Chart Trading. The goal of this webinar is to help you improve your skills in chart trading and applied technical analysis. We will continue talking about specific patterns and trading setups that are visible on a naked price chart. It can be used without any indicators or with indicators, it's up to you. All ideas discussed in this webinar were somehow used for trading either for me or students of my educational groups, so they have practical application and they are based on trading experience. Now we are getting started. First of all, let's take a quick look at the disclaimer. Please beware of financial risk associated with trading. Information in this webinar is provided for educational purposes only and by no means can serve as a trading or investment advice. You will have full responsibility for your trading decisions, so we strongly encourage you to test any ideas or concepts on a simulator or using a historical backtest before putting real money at risk. Before we start talking about price action, about analysis, about chart trading, you have to remember that price action for smaller time frames will be different from price action for larger time frames, because we have more conflicting information when we trade within a day, so we can rely more on levels. Once we have a level, we can get confirmation from the price that the level is being broken out or the level is being rejected. And we have not so much variety of setups here. And in the left column you see a few setups. You see initiative break and you see the test or the probe. Of course, they can be represented in many forms, but actually we have two major setups. We have initiative break or we have a test. But the main thing here is a level or a trade location. Once we have a good trade location, we can confirm our scenario with certain price action. And when we have larger time frames, we have more setups because the information on larger time frames is more relevant. And in this webinar we will discuss here such patterns as simple correctional pattern, engulfing pattern, pin bar, inside bar, measuring bar with elongation. We will go through some charts. I will show you ideas for trades. I will show you trades that were made in the past, and I hope that you will get pretty clear understanding of how it works. And let's start with a very simple setup that can be viewed on small time frames like 30-minute charts or hourly charts. It can be also viewed on daily charts or even weekly charts sometimes, but when you employ this pattern on small time frames you can achieve the best profit-loss ratio. First of all, we have to see initiative action beyond some important reference point or important level. Initiative action occurs when we have price emerging from current trading range. It is inside-out action. We see the price getting away from the value, getting away from the trading range. And initiative break occurs when we see candlestick or bar closing at its high or low on the outer side of the level, like it is shown here on this slide. In most cases you expect to see preliminary action with reduced volatility, sequence of doji bars or doji candlesticks. It can be 2 or 3 hours of consolidation before market breaks, and then you have to see initiative break. For example, if you see the candlestick with the shadow, with the shadow, it doesn't mean that you have an initiative break, because in this case you have pretty aggressive responsive action. So the very important principle using this setup is to see no pressure from sellers in case price breaks to the upside, and no pressure from buyers in case it breaks out to the downside. Market advertises higher or lower and faces no responsive action. This is very important, because when you see responsive action, you see the pin bar, for example, it doesn't mean that you have an initiative break. And once you see no responsive action, you can work with this opportunity. You can use this to build an asymmetric trade with expectation of good risk-reward ratio. Once you have identified initiative break, you can build an area of support around the exact bar or candlestick that was breaking the level. In this particular example, we have the breakout to the upside with this candlestick, and we can build a position on a pullback, for example. Well, nobody will tell you exactly how deep the pullback will be, but you can buy, for example, on 50% retracement from the initiative action, from the initiative candlestick. This is the first way to do that. And eventually you can just buy after it closes and set your stop loss below the low of this initiative bar or initiative candlestick. Once this area is violated, market is becoming too weak and odds are stacking against your position, and they are stacking against continuation, so you can get rid of your position and search for a next pattern. On this slide you see the particular example of the trade that was made on my account recently. It is Euro versus British Pound. You see first of all the trade location represented in a red line here. Market has broken out the trade location or the level with a candlestick of a very small body. The next bar or next candlestick is testing the area of the support, and we have two more opportunities to enter on the 50% retracement here. Every pullback here allows us to build a position with good parameters of profit-loss ratio. Well, it is too good to be true, right? But not. It's an actual real trade. Also, you have a very tight stop here, and you can be stopped out of this trade and exit a position in case price breaks the support area to the downside. And you see that the continuation within a day was pretty good. So we had a trending day with elongation to the upside, and it was about 4-to-1 profit-loss ratio, or maybe 5-to-1 profit-loss ratio, I don't remember exactly. And this is a good example of the trade. The example that you see on this slide is pretty similar with minor differences. You see that price tests higher levels with several candlesticks. And what candlestick is considered to be the initiative break? Well, why is the third one better than the second one or the first one? Well, to identify the real initiative break, we should go to the higher time frame and see what happens there. If we see any meaningful extreme, we just build a level using this extreme and identify the real initiative break, because the action within a trading range is relatively less important than action outside of trading range. Because when price goes or moves within a trading range, it can be the result of algorithmic trading, of mechanical trading, it can be result of day trading, whatever. But once price breaks out from the level, possibly other time frame buyer will enter the game. In this example we see that initiative activity had started from inside of the range. The low of the candlestick representing the initiative break does not correspond to the local high. So the area of support slightly overlaps the previous trading range. And you shouldn't be surprised observing the minor pullback within a range like it is shown here. It can give you really the opportunity to enter the market, to enter the trade. And area of support works pretty accurately here. Now let's look how it works on real chart. I want you to pay attention on the recent activity from American dollar versus Japanese yen. As you already know, before putting any trade, we have to identify market conditions. And in this case, first, the market was ready to generate movements to both sides of the trading range to collect liquidity, to collect stops, and after that it was starting to validate higher levels. It is preparing possibly for the breakout or for more elongated movement. Well, it can be both to the upside or to the downside. We don't know the exact destination. And the first thing that we see here is additional structure building at the top of this range. And the key day is here. Key day that we see here is November 4th. Let me do it larger for you. Okay, so sorry, here is this day. You see that initiative break occurs with this candlestick, and after that we just build the support area, and we have several opportunities to enter the market on 50% retracement here, and eventually market prepares for the break. You see that here we have completely reduced volatility. Volatility is very small. It is preparation for the breakout, and market is going from the paradigm shift area to the impulse phase. And here you see another example from Australian dollar versus Japanese yen. And first of all, you see the pretty long sideways action here, lasting for about 3 weeks. It had started here on October 23rd. Then we have several weeks of sideways action, and eventually market has broken out the 88 level that is considered to be the trade location for a breakout momentum trade here. And also it's not only the previous day's high that is being broken, but also the border of the large trading range that is being broken. So we are breaking out two levels simultaneously. First of all, it is an extreme of the previous day, and it is also the higher border of the large trading range. And you see that here we have the initiative break. That is the exact candlestick or exact bar that we can rely on building the support area. What do we see here? November 19th, we have a test and market goes higher, it closes higher. Then the action develops within November 20, November 23rd and November 24th we see again the pullback to this area, again the pullback, and guess what is the level that supports the price? That is the support area built by the initiative candlestick. You see how it works? So we can even build a position after the 3 or 4 days of the sideways action. Well, this position looks pretty good in history, right? But in the real time it will be not very psychologically easy to execute such position, because you have a descending movement and you are going to go counter trend. And that's why in my trading I try to enter a position within the short-term period. Once market breaks out a level, I can enter the first pullback, and after 3 or 4 days of the action, I might not enter the position because it's pretty risky here. But of course it looks good here in this trade. If you are a risky trader, if you can go counter trend here, if you can afford a small loss here in case you are not right, you will get very good trade having more than 5-to-1 profit loss ratio here. And also keep in mind that the next time market breaks this level or touches this level, odds are stacking against you. But in fact also we have a test, and eventually market generates the elongated movement to the upside. So you see how it works. I will show you just it on a daily chart. It is visible also on a daily chart. You see how this level works. 3 times. We have 3 times of market coming to this level, testing this level before it breaks. And you might ask, why not to build a trading range using this extreme? Well, I would say that we have to pay attention to the levels that are located, or extremes that are located around one level. So the higher level, the higher extreme, is excessive one. So we might not pay attention to this extreme. Extremes that are important for us, they lean to 88 level. But what if we pay attention to Australian dollar versus American dollar? I have shown you Australian versus Japanese yen in the previous example. But as for Australian dollar versus American dollar itself, you see that you also have a level, but it is not as good because it is located right in the center of the range. So you don't have any meaningful extremes here. What do I call the meaningful extreme? I call the meaningful extreme that also lies somewhere at the border of the range. Here we have just a sideways action. If we switch to 30-minute chart, we also see some extremes, but it's not elongated structure. So we have just 2 weeks of sideways action with pretty high volatility here. Well, it might be the rotational center located right in the center of the range, but if I have to choose between 2 setups, I would choose Australian versus Japanese yen because it looks better. I have much better structure here, much better setup. Okay, now let's switch to the next setup that I call the test or the probe. Before market is ready to move in opposite direction and reverse, it can generate a test to the direction of the previous short-term trend. So even if you see any reversal pattern, even if you have good trade location and market has already started to move in the direction of your forecast or analysis, it can go back, test the area or level, and then resume going in the direction of the previous break. And a typical example of the probe or the test you can see on this slide. First we see the market breaking out to the downside. We have 2 trending days with 2 days of sideways action followed. On the 3rd day we have pretty good level, pretty decent level here, and before market is ready to break out to the downside, it has to generate a test. So we see the level, and we see that our market condition is pretty bearish here, but before market is ready to go, it just tests and validates the level. It looks if there is a hidden demand here. Once it is clear that there is no demand here, market is ready to go down. In this example we have a pretty good trending context. Market was leaning to the lower side of the chart before it was building the trading range. It is possibly 4-day balance, and correctional move has followed. So we can start to think about going against this trend. But to do so, we have to see the level. We have to see the level, and we have to see the test. Once we see the small area of consolidation, once we see the good level, we have to see the test. Well, the test is typically the shadow, maybe 5 to 10 ticks above the level, and it is obvious pretty quickly that there is no continuation here, and then market is ready to go to the opposite direction. So you can initiate a trade here or even here if you are a risky trader. So you can enter in the point 1 or enter in the point 2, which is less risky. Now let's look how it works on the real charts. I wanted to show you example from New Zealand dollar because it has very good trending context. We had market renewing lows, setting new lows consistently, and correctional move has followed here, and the day of false breakout is November 20, and let's look in more detailed mode how it works. Let's go to November 20 and see what happens here. So here is the border of the range, market goes higher, establishes the candlestick here and a small shadow. It might be considered as an initiative break, but actually it's not an initiative break because we have pretty aggressive pressure from the upside. So using this trade location we can initiate a short trade to move to the downside, or if you can reduce your risk you can even place a stop order, sell stop order here to generate a trade. Well, in this case your profit will be smaller. We don't know whether the market is going to visit lowest low here because the most expected profit here is the center of the range. So our projected target can lie in the center of the range, and it has to be a mean reversion trade. When we trade using the mean reversion, we expect that the market goes back to the center of the range, but we don't know whether the market is going to get back to the lowest side of the range. Now let's talk about patterns for higher time frames. We can pay more attention to specific candlestick or bar configurations in this case because information is already filtered in this time frame. And the best way to trade using any patterns is to work within an impulse phase, when the market is going away from value very quickly, generating very small correctional moves. So we can capture the breakout momentum trade using one of these correctional movements. You can even build a moving average here like I was showing you in previous webinars. But as price is going away from value, you might not see the test of any moving average, either fast or slow. Eventually market can re-enter the trade location between two moving averages, but in an impulse phase it is just going away and it is a very quick process, so your trades are expected to be made with locations shown here. So you guess that those trades can be breakout momentum trades. There are a few rules for identifying good opportunity using simple correctional pattern. The first is to see sequence of descending bars or candlesticks going one after another. Of course, if your initial impulse was ascending. You have 2 to 3 bars or candlesticks moving against a trend, and it is better when the last bar in this correctional phase will show you participation of buyers. For example, it can be shown in a form of a pin bar, the candlestick or a bar with very long shadow and a very small body. And your entry point is considered to be executed just above the high of this pin bar. In many cases you can see minor elongation, and the market will show you another 2 to 3 days or maybe 4 days of consolidation. But in an active trend, market is about to grow faster. When you initiate a trade, it can grow faster, renewing highs or at least revisiting highs very quickly. Your stop loss is expected to be placed below this pattern. Yet there are several ways to place a stop, and we will dedicate a special webinar to this topic. For the short trade, it works the opposite way. So you see 1, 2, maybe 3 bars against the initial movement, and you place a sell stop order below the low of the pin bar, and you go with the breakout momentum trade. Well, example shown here is inappropriate for trading. Of course, it can work in some cases, but our goal is to accept best setups and stack the odds in our favor. Here we don't see participation of buyers because the last candlestick in this sequence is not showing any participation. Market just reacts on achieved level, and there is not enough reason to enter trade here. But when we combine simple correctional pattern with engulfing pattern, it can improve the odds. If the last bar in this correctional phase was not showing any participation of buyers, we can still initiate a trade in case engulfing pattern shows up. If the third candlestick in this configuration engulfs the second one, you can place your buy stop order here and initiate a trade. Of course, in case the distance between high and your entry point is not too short. Here is an example of how it works. Market breaks from the trading range pretty aggressively, then pulls back, and once we see engulfing pattern, we can enter a trade to capture a continuation. Remember that it will work better on charts of higher time frames. It is very important to mention that we have to work with active trending impulse. If we haven't seen any highs and swing was completed within a range, we can't pay attention to any engulfing patterns in this case. All setups and patterns occurring within a balance are of less importance than those occurring outside of balance. In this example, you see that even if we have correctional move, even if we have engulfing pattern, but we don't have new high established. So this pattern cannot be used for trading. Now let us look at the recent example of Swiss franc or the American dollar versus Swiss franc, and we see that once price had emerged from the trading range, let us see it in more detailed mode, we have observed simple correctional pattern here. We have 1, 2, 3, 1, 2, 3 correctional bars of candlesticks with engulfing pattern followed. So entering here or even here, we have pretty good odds of entering a good trade. Well, of course your stops are expected to be at quite a distance because it is a daily chart, but your expectation of reward increases here. So it is not a short-term trade, it is more long-term. Okay, now we are finishing this webinar. I hope that it was interesting for you and some ideas will be used in your trading. In the next webinar we will talk about preparation for the trading day and the balance between supply and demand, key reference points the trader has to keep in mind. If you have questions or comments to this video, feel free to leave them below and I will do my best to answer all of your questions. Please be specific in your questions to receive a good answer. Good luck and see you in the next video.